When most people look at crypto, they start with the same question. Is the price going up or down? And honestly, that makes sense. Price is the easiest thing to see. But if you only follow price, you're usually late. Because price is the result. The real signals often show up before the move. ETF flows, stablecoin liquidity, volume, exchange reserves, regulation, network activity. In this video, we'll break down how to read crypto market signals beyond price. Let's start with price. Price matters. Of course it does. But price alone does not tell you why something is moving. If Bitcoin goes up 5%, the better question is not just how much did it move? The better question is what supported the move? Was trading volume strong? Were ETF inflows positive? Did stablecoin liquidity increase? Was there a major regulation update? Or was it just short-term hype? That context matters, because two price moves can look the same on a chart, but mean completely different things underneath. The next signal is ETF flows. This is especially important for Bitcoin and Ethereum. An inflow means money is entering an ETF. An outflow means money is leaving. Simple. But here's the important part. ETF flows can show how larger investors are behaving. If inflows continue for several days or weeks, it can suggest stronger institutional demand. But one big inflow on one day does not tell the whole story. Same with one outflow. The trend matters more than the headline. So don't look at ETF flows like a prediction. Look at them like a demand signal. They don't tell you the future, but they do show where bigger money is moving. Now let's talk about stablecoins. You can think of stablecoins as the cash layer of crypto. People use them to move money between exchanges, tokens, DeFi apps, and trading pairs. That's why stablecoin liquidity is important. If stablecoin supply is growing, it can mean there is more usable money inside the crypto system. If liquidity is weak, price moves can become sharper, more unstable, and easier to reverse. So stablecoins are not just digital dollars. They help show whether money is actually available inside the market, and that gives you a better picture than price alone. Another signal is volume. Volume tells you how much activity is behind a move. A price increase with strong volume can be more meaningful. A price increase with weak volume can be fragile. Then there is market depth. Market depth shows how much buying and selling interest exists around the current price. If depth is thin, one large order can move the price quickly. This is also why spread matters. The spread is the gap between the buy price and the sell price. When the spread is wide, trading becomes more expensive. So before you trust a move, check if the market actually has strength behind it. Exchange reserves are another useful signal. They show how much crypto is sitting on exchanges. Why does that matter? Because coins on exchanges are easier to sell. If a lot of Bitcoin or Ethereum moves on to exchanges, some analysts read that as possible selling pressure. If coins move off exchanges, it may suggest people are holding them in wallets instead. But be careful. Exchange reserves are useful, but they are not magic. They should never be read alone. Use them together with volume, liquidity, price action, and market news. One signal is never enough. Regulation is another signal people often misunderstand. It's not only about bans. Regulation can affect which platforms can operate, how stablecoins are issued, how ETFs are approved, and how institutions enter the market. So when you see a regulation headline, don't just ask, is this good or bad? Ask, who does this affect? Exchanges? Stablecoins? ETF products? Users? Developers? That question gives you a much better reading of the news. Because regulation can change the structure of the market, not just the mood of the day. The final signal is infrastructure. This is not always exciting, but it matters a lot. Look at things like Layer 2 upgrades, gas fees, transaction counts, active addresses, developer activity, and network upgrades. These signals show whether crypto is becoming easier, cheaper, and more useful. A price chart can move in one day, but real adoption usually takes years of infrastructure work. That's why Layer 2 networks, wallet improvements, and blockchain upgrades matter. They may not always create big headlines, but they are what make crypto usable. So the next time you look at crypto, don't only ask, did the price move? Ask, what supported the move? Was there real volume? Were ETF flows strong? Was liquidity improving? Were coins moving on or off exchanges? Did regulation change the environment? Is the infrastructure getting better? That's how you move from reacting to headlines to understanding market signals. Less noise, more context, better decisions.